Just before Charlie Munger passed away, he issued a famous warning.
Do you expect the next 10 years to have lower returns in the equity markets than the last 10?
The answer is yes. I think that returns will go down, yes.
Warren Buffett in 1999 issued a similar type warning. He predicted that because of the tech bubble and high prices, real returns will be 4% or lower going forward. Fast forward, in hindsight, he was right, stocks crashed and real returns were only 2.5%. Today, it's like we have deja vu. The new disruption is not tech, it's not automobiles or aviation, it's AI. And everything feels exactly like it did in '99. Prices are at record-breaking levels. Investors are frothing over this fresh opportunity. New AI stocks are popping up everywhere. Does this mean, just like we saw in 2000, we will see a new lost decade? To answer this question, we need to understand deeper what happened in the past and go back to Warren Buffett's warning in 1999. The three major technological disruptions before AI were the internet, automobiles, and aviation. If we know exactly what happened with these three, then we can get a better feel for what may happen with AI and AI stocks. At the end of the video, we're going to talk about how to prepare. But first, let's rewind 100 or so years and start with what happened in automobiles. Buffett wrote, "Take automobiles first. I have here one page out of 70 in total of car and truck manufacturers that have operated in this country. At one time, there was a Berkshire car and an Omaha car. Naturally, I noticed those. But there was also a telephone book of others. All told, there appear to have been at least 2,000 car makes in an industry that had an incredible impact on people's lives. I have a question for you. Out of those 2,000 automobile car companies, how many of them do you think are around today? Go on Forecast and see how many automobile stocks survived from back then. You're not going to find a whole lot. The answer, as Buffett wrote, is just 3. General Motors, Ford Motor Company, and Chrysler. So that is not even 1% that survived. It's 1/6 of 1% that are still here today. 3 out of 2,000. So if you were to be put back in time to the boom of automobiles and you thought correctly that automobiles would change the world, you would have a 0.15% chance that the stock that you picked would still survive into the future. That's not exactly an easy pitch, as you'd say in baseball terms. Keep this concept firmly in mind when thinking about which new AI stocks to buy in today's market, or if someone is pitching you the next AI 100x opportunity.
Investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow. Or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices.
Now, there is a big problem with prices being pushed to the moon. The problem is they can't go up forever. I know, I'm sorry to spoil the mood. Anyone who knows investing knows that the price you pay implicitly affects the return you get into the future. If you buy a company for dirt cheap, even if it performs poorly, you can still make money. On the flip side, if you overpay for a stock, that company can perform magnificently and you can still get 0 returns. Just look at what happened with Cathie Wood's stock Roku. In 5 years, sales went from 1.8 billion to 4.4 billion, more than doubling in underlying revenue. And what did the stock's price do? It fell from $470 to $100. It went down 78% despite doubling sales. Why? It's because she overpaid. This is the reason why Munger was warning of a lost decade before he passed away. It's not because the companies themselves won't do good business over the next 10 years. It's because prices are very high. And it's for this same reason why Buffett expected 4% real returns back in 1999. Prices were just too inflated. Now let's go to the second point in history, which is aviation. We're not doing this history lesson for fun. We're doing this because everything relates back to what's happening today with AI and the stock market. At the end, we're going to talk about how to prepare. I'm going to show you 3 key ways that Buffett talks about. Winston Churchill famously said, "Those who fail to learn from history are doomed to repeat it." Let's not be one of those people and take a quick rewind through time into the aviation boom. This is from Warren Buffett's article. Move on to the failures of airlines. Here's a list of 129 airlines that in the past 20 years filed for bankruptcy. Continental was smart enough to make that list twice. As of 1992, in fact, though the picture would have improved since then, the money that had been made since the dawn of aviation by all of this country's airline companies was zero. Absolutely zero. Obviously, I'm assuming that none of us watching were around at the time of the 1920s aviation boom, but there's a lot of parallels that we can draw with this and AI today. Post World War I, thousands of surplus military planes and trained pilots flooded the civilian market. Many small aviation startups were founded, most of them were short-lived. Investors were excited by the idea of travel, a lot like how automobiles boomed a while earlier, but by the late 20s, things became a frenzy. Charles Lindbergh's 1927 solo transatlantic flight set off a huge wave. Aviation stocks soared, new airlines were launched almost weekly, and aviation was seen as the industry of the future. Between 1927 and 1929, there were hundreds of new aviation companies formed in the US, similar to what's happening in AI today. But of course, the 1930s came along, and just like what happened with automobiles, consolidation followed. Most of those companies went bankrupt, leaving only a few giants: Boeing, Lockheed, Douglas, etc. And by the time of World War II, there was only a handful of serious aviation players that remained. In fact, aviation ended up hurting investors so much over the years that Buffett finished off his section with this. He said, "Sizing all of this up, I like to think that if I'd been at Kitty Hawk in 1903 when Orville Wright took off, I would have been far-sighted enough and public-spirited enough. I owed this to future capitalists to shoot him down." I mean, Karl Marx doesn't have as much damage to capitalists as Orville did. Orville Wright was of course the first man to fly a plane, and he's credited with the birth of aviation. But his invention did not help investors at all, so much so that Buffett joked around that it was better for us investors if he shot the plane down, because although the invention was great for the world, it destroyed investors' capital. Once again, keep this firmly in mind when thinking about what may happen with AI, because all of the parallels are there.
Things can go on a long time that don't make sense, but they do come to an end. I mean, the internet thing, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now that seems pretty, but think about that. And particularly think about it next time you're trying to do something just because the stock's gone up a whole lot. Your neighbors made money or something. You've got to you just have to sit and think objectively.
So let's do what Buffett said and sit and think objectively. In 1999, just before the dot-com bust, stocks were at all-time highs. 2025, stocks are at all-time highs. In 1999, the Shiller PE ratio was at a breakout level at 44. In 2025, the Shiller PE ratio is at a breakout level of 40. In 1999, the Buffett indicator was 2 standard deviations above the norm. In 2025, the Buffett indicator is also 2 standard deviations above the norm. In 1999, everyone would finish their company name with .com, just like they used to finish their name with Motors in the early 1900s, just like companies finish their name with AI today. The similarities are all there, and it leaves us with the question, are we now too going to experience a lost decade just like they did in the past? Let's address this, and at the end, we'll talk about how to prepare. The major parallel between what's going on with AI today is what happened with internet companies in 2000. 62% of my audience is above the age of 35, so I'm sure a decent amount of you know how it was investing in those markets. Everything was going to the moon, and it was all because of the internet. The internet will change the world, and therefore business will boom. So the obvious answer is to buy stocks, right? Well, let's see how stocks performed if you bought in the year 2000. The S&P 500 peaked at 1,517 points in August 2000. Of course, then we saw the huge collapse of the groundbreaking tech companies, and the market would only break out of that previous high 13 years later in February 2013. Essentially a lost decade and 3 years. But this lost decade phenomena has occurred numerous times in history. Let's look at a few more so that we can see if we might happen upon one today. Of course, first we have the decade that Buffett talked about in the article. Buffett pointed out that December 31st, 1964, the Dow Jones Industrial Average closed at 874 points, and then 17 years later, December 31st, 1981, the Dow closed at 875 points. It went up 1 point over a 17-year time span. So obviously, businesses themselves must have performed poorly, right? generated low profit, struggled to grow, GDP increases minimal. Wrong. Warren Buffett wrote, and here's a major and very opposite fact. During that same 17 years, the GDP of the US, that is, the business being done in this country, almost quintupled, rising by 370%. Or if we look at another measure, the sales of the Fortune 500 more than sextupled. And yet the Dow went exactly nowhere. So be careful. These lost decades can creep up on you. They can come out of nowhere and they can go completely against the general tide of business results.
In 1964, the Dow closed at 864. Then in 1981, 17 years later, it closed at 865. It moved 1 point in 17 years. Now, that's not a big move. And that, you can't believe how discouraged people were.
The lost decade phenomena happened during the aviation boom too. Prices started getting frothy during the late 20s, and by 1929 they were all blown out. Dow was at 31.7 points. Do you know how long prices would take to recover to these all-time highs? 10 years? No. 20 years? No. It would take until September 1954 before the Dow would recover to the points that it had been in 1929. That's a 25-year lost decade. That is a long way to see your stocks recover to what you'd originally paid for them. And then of course there's the argument that we're in a modern economy now, and these are phenomena of the past and they're unlikely to occur again. Well, have you studied Japan? This was once the second largest economy in the world. It was at the forefront of technological innovation and had a seemingly unbreakable economy. But do you know what happened to their market? The Nikkei 225 in December 1989 peaked at 38,100 points. Fast forward many years, and in June 2025, the index was at 38,450 points. If my math served me correct, that's a 36-year lost period. A triple and a half lost decade. History shows us that you have to be careful of inflated markets, which brings us to where we are today.
Are we witnessing the most overbought market in history?
This market reminds me a lot of 1999. It just goes up every day. Nobody knows why. There's a narrative. They'll always have some sort of narrative, but they just go up.
There hasn't been a serious market correction in 16 years, so people get out of the habit of thinking about market corrections. Biggest single mistake investors make. And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen, whereas reversion to the mean is much more likely.
But I want to present a different side to the story. Yes, markets are pricey. Yes, they've been going up for 16 years without a meaningful correction. But what is the one thing that Buffett says affects the stock market the most? The push and the pull that is so strong on the market that Buffett refers to it as gravity on stocks. It's the interest rate, of course. And have you been following what's been happening with interest rates? Of course, we had the great steepening of interest rates from 2022 through to mid-23, and then they remained reasonably flat for a while. But of course, the latest is that Jerome Powell is dropping interest rates. And in that announcement, the Fed officials indicated that they expect 2 more quarter-point rate cuts this year. So if interest rates are dropping, does that not mean that one of the biggest forces on the stock market is now easing, allowing less pressure pulling it down and more pressure pushing it up? Yes, that's exactly what it means. So don't be surprised if in the rest of 2025 and 26, the market keeps going higher and higher. Remember, in 98 and 99, the market did the same thing. Lowering interest rates is a huge push on the market. Also, if you go to Forecaster, who are the sponsor of today's video, click on the S&P 500 index and then click on the projections tab. The best match scenario, aka the most correlated event, is still projecting stocks to go up. And this tool has studied past events dating all the way back to 1994. So it's a detailed analysis that's been done. It's not just pulling these projections out from nowhere. Forecaster's projections tool studies the past to get a feel for what's going to happen in the future. It's kind of like what we did in this video. We rewinded through previous market crashes to try and understand what's going to happen today. And the projections tool can do this with any stock that you want. Amazon, Meta, Google, Nvidia. You can try it with your stock that you're interested in or that you own by clicking the link in the description or the pinned comment, and you'll get 10% off Forecaster's website. So if we look at the market now, we we have this weird mix of ingredients: extraordinary high prices, a new technology expected to disrupt everything, but interest rates that are lowering. That is a counteractive force. It's like if you served a spicy curry to your new house guests, they're either going to love it or hate it. And that's how I see the market right now with the unique mix. Will it love the lower interest rates, or will the risk of prices be too much? And if it is too much, let's think about how to prepare the Buffett way. We have 3 Warren Buffett ways to prepare for these market conditions. The first 2, we're going to take the advice of other people who say, look at what Warren Buffett does, not what he says. And then number 3 is we're going to look at what he says. This is the tactic that Buffett teaches on how to really make money from a new technology like AI. Very important. So, starting with number 1, and that is holding cash. Right now, Warren Buffett holds a record amount of cash on Berkshire's books. Go to Forecaster, type in Berkshire Hathaway, and go to their balance sheet, and you can see that he is sitting on, get this, $344 billion of cash. That's a lot. Just look at that increase in cash since 2022, and that comes because 1, he's struggling to find good deals in the current market, and 2, he's just playing the game safer right now. Buffett, he did the same in and around the dot-com crash, where he just held safely onto his cash position. Moving on to number 2 on what Buffett is doing, not what he's saying, and that is he's investing very conservatively. I've studied his stock buys in depth, I've done deep analyses on each stock that he's bought, and he's not buying the Nvidias, the Palantirs, the snowflakes of this world. No, those P ratios are too expensive for him. He's buying conservative stocks that no finance influencer is talking about. Lena, Allegion, Nucor. Haven't heard of those stocks? There's probably a reason for that. Low in popularity stocks generally means lower prices, and lower prices generally means Buffett loves it. So conservative, because if a crash comes, conservative stocks are more likely to conserve your capital. They might crash, but they'll crash by a lot less than the tech and the AI stocks. And now for the third tactic, and this one is so clever because it's counterintuitive. How do we profit from the growth in AI? Well, we invest in AI stocks, right? High growth AI companies. That is what most people would think. Buffett wrote in his famous article, How to Profit from a Disruptive Technology, in a completely different way. Sometimes, incidentally, it's much easier in these transforming events to figure out the losers. You could have grasped the importance of the auto when it came along, but still found it hard to pick companies that would make you money. But there was one obvious decision you could have made back then. It's better sometimes to turn these things upside down, and that was to short horses. Frankly, I'm disappointed that the Buffett family was not short horses through this entire period, and we really had no excuse. Living in Nebraska, we would have found it super easy to borrow horses and avoid a short squeeze. He's recommending investing the exact opposite of what most people are saying. If we go by Buffett's thinking, we should not be putting everything into AI and instead be shorting the companies that AI is disrupting. The legacy IT companies, the core centers of this world, the taxi industry. It's different, but it may be the real way to make money in the AI era. Thank you, Forecaster, for sponsoring this video. Don't forget to check the link in the description to get 10% off this quality stock market website.